Hello and welcome everyone. We are back with yet another discussion of a special topic in your SBL preparation, which is agency theory. Agency theory relates very closely with corporate governance, and it is a concept that will be applied in a lot of other places throughout our SBL journey. The concept itself is small, it isn't much, but very critical for your preparation because the application of this concept will enhance the quality of your answers. So, let's understand the idea of corporate governance first in brief, because we'll have a separate discussion on corporate governance later. We'll have a brief discussion on corporate governance and then we'll go into agency theory. Now, now what exactly is agency theory? Why are we studying that in SBL? We'll get into all of that. Just give me a moment. Now, the very idea of corporate governance is, see, these are principles of good corporate behavior. Now, when your family, your mother keeps on telling you all the time, get up early in the morning, work out, sleep at the appropriate time at night, don't use your phone too much, eat healthy, whatever those basic tenets of human behavior are. Now, is this a law? Has it been given in any act? Like, for example, you have to file your returns by 30th September has been written in the Income Tax Act. So that is a law. Nobody has made a law that you have to wake up at 6 a.m. in the morning. There's no law. But if you want to lead a healthy lifestyle, then waking up at 6 a.m. is considered one of those principles of good behavior, which will help you to lead a healthy life. Corporate governance is just like that. Corporate governance is basically the set of, I wouldn't say rules and regulations, but some underlying principles which are the foundation of good corporate behavior. So how exactly should a company behave? How exactly should a business entity operate when it is, functioning in the world around itself? What are some of those basic non-negotiable principles that they should base their policies on is what corporate governance is all about. For example, every company should have uh, an equal opportunity policy for men, women, and right now, even people belonging to the third gender. So now these are improvements, these are now principles of good corporate behavior that companies are trying to lay down. So, corporate governance, what started off as an idea of appropriate corporate behavior, has slowly and surely emerged into a discipline in itself. Like, in today's day and age, I'm sure you have heard that there are companies which give mental health breaks. There are companies which give menstrual leave to women. Now, what are these? This is not necessarily codified in a law, but you want to be an empathetic organization. You want to make sure that the people who are working with you, they feel safe, dignified, and protected. And only when they feel that will they contribute more to the performance of the organization. These tenets of good behavior are what I could say the cornerstones, the pillars of corporate governance. So it concerns the way, it's not a law, by the way, it's just codified guidelines in terms of how a company, an organization, and its key managerial personnel should conduct themselves. A good system of corporate governance aims to ensure that directors act in the interest of shareholders and other stakeholders while being held accountable for their actions and decisions. Now, in any company, say a company like Reliance India Limited or Zomato or whatever company you can think of, I hold, for example, I have 50 shares in Reliance. Okay. I hold 50 shares of Reliance India Limited. My question is, am I an owner? Yes, I am an owner of Reliance, but I am a part owner. I am a part owner. You are an owner. Mukesh Ambani is an owner. All of us are part owners of this company called Reliance India Limited. Now, what does a good system of corporate governance mean? See, pay attention to the fact that while all of us are owners of the company, not all of us can participate in the day-to-day running of the company, right? All of us don't have the time or the capability to be a part of the day-to-day decision making. Plus, if the company were to constantly keep on, taking votes from shareholders, it will spend the entire year only taking votes and you will never reach any conclusion. So, what we do is all of us shareholders, we sit together once in a year and we nominate certain people or we vote for certain people to run the company on our behalf. These people are known as directors. We are the owners. It is our money that is invested in the company. The company is going to use our money to conduct its operations, but we cannot participate in the day-to-day running of the business. So we appoint these directors to run the company on our behalf. Now, there is a possibility that because these directors have access to so much funds, so many resources at any given point in time, quite possible that they might start using this money not necessarily for the greater good of the company, but for their own personal benefit. So you need a set of guidelines which will guide their good behavior, which will guide their ideal behavior, so that they work for the interest of the company and not solely for their own personal growth and gains. So here there is an owner, which is the shareholder like you and me, and then there are directors who are running the company on our behalf. We need certain guidelines in terms of how the relationship between these two works, and that is going to be the basic discussion of agency theory. So there is a separation of ownership and control. The shareholders are the owners, the directors are the ones who are running the company on behalf of the shareholders. Okay, and our discussion today of agency theory is going to dive deeper into it. As I told you, corporate governance is a small discussion right now. We'll take it up later when we have a separate topic on that. Now, as I told you, there is no law, like there is an Income Tax Act 1961, there is no Corporate Governance Act, but these are codified principles, guidelines of ideal corporate behavior, and the whole idea of corporate governance. Of course, there are multiple theories and multiple proponents, but we'll go with the one given by OECD, which is the Organization of Economic Cooperation and Development. OECD defines corporate governance as the system by which business corporations are directed and controlled. The corporate governance structure specifies the distribution of rights and responsibilities among different participants in the corporation and spells out the rules and procedures for making decisions on corporate affairs. So, beyond what is given under companies law, beyond what is given under Foreign Exchange Management Act, beyond anything that is given under any law, there is still a lot of scope for companies to, act in a situation appropriate manner, act in a manner, which does not harm the interests of the stakeholders, act in a manner which is most beneficial to all the stakeholders. All of that taken together is what the idea of corporate governance is all about. This comprehensive definition highlights how corporate governance establishes clear frameworks for decision making, accountability, and the balance of power within corporations. When I say balance of power, we'll study that later in terms of how do corporate governance principles help you in um, preservation of the rights of the minority shareholders, for example. So all of that together is a part of the discussion on corporate governance. Now, if you go back in time, see, earlier businesses were mostly owner managed businesses. Tomorrow, if I decide to start my own coaching class, also, it will be an owner managed business. All the decisions will be taken by me. But when the scale grows, when I need more funds, when I need more hands and brains and expertise, naturally operating through a sole trader is not going to be beneficial. I'll have to incorporate a company with different experts handling different parts of my organization. And here, as the market grows, as my organization grows, I'll need more and more experts. I'll need more staff members to run the company on my behalf. That is the phase of corporate expansion. Once my company grows even bigger, I would want to raise money from the public. I would want to get my company listed on the stock exchange. And see, the whole idea behind listing is that I need more money, and my current available set of resources are not able to provide me that money. So, how do I get that money? I get that money by raising funds from the public. And that can be done via a stock exchange mechanism. Your IPOs and FPOs are basically ways and means to achieve that. And as organizations grow, as they start working in complex business environments, it becomes all the more critical to have a system in place for tackling all challenges, because the challenges in 2025 are very different from the challenges in 2005. Today, your challenges are not just, achieving the perfect sales mix or price setting, but today there are so many other aspects. For example, the actions of competitors or the impact of social media on your business, or the impact of performance marketing on, scaling up the overall level of operations. So all of that is basically what modern challenges in 2025 regarding businesses are. And to tackle these modern challenges, I just mentioned a few. You're working with Gen Zs. That is also a very different challenge that we are facing these days. So when you have to tackle these challenges, you need systems in place which were probably not in existence before. And it has constant adaptability is the only way forward, and which is why our principles need to be agile enough, our principles need to be nimble enough, so that when these challenges come and when businesses go through a rapid change, a rapid expansion, at each of these points, uh, understanding the way to tackle these challenges and how not to let your basic values get impacted in the process, I think that is where your focus should be, and that is what we are going to study now. Now, assume that you want to sell a house. Okay. Now, you can stand in the middle of the road with a loudspeaker in your hand, yelling at the top of your voice that I need a buyer, and this is the square foot area of my house. This is the price. You can't do that. You probably won't get any buyer that way. So, in order to make this deal possible, what you do is you appoint an individual who is basically going to carry out this activity on your behalf. He will do the prospecting, he will find the buyer, he will arrange the meeting, he will help in the negotiation, and he will help you with the sale. And what he expects in return is that he expects a certain commission. Now, I am the owner. So the how it is my house that is being sold. I am the principal, and this individual is acting on my behalf. He is my agent. So this is the principal agent relationship, which is the basis for agency theory. Now, in case of a company, the shareholders are the owners. It is the money of the shareholders that is being used for running the company. So, shareholders are the principals. But as we discussed, shareholders do not participate in the decision making and running of the company on a daily basis. Someone else does it on their behalf. And that other person who does it on their behalf is who? It is the directors of the company. The shareholders in the annual general meeting have gotten together and they have voted for, say, five people to run the company on their behalf. It is the money of the shareholders which the directors are using for running the company. So the shareholders are the principals and the directors are the agent. And this is the agency relationship that we are going to study here. Now, when we talk about agency theory, there are a couple of concepts that need your attention. The first one is agency cost. The expenses incurred in establishing and monitoring agents, including verification of management activities and control mechanisms. Now, see, while you could appoint directors to run the company on your behalf, you need to make sure that the right people are appointed for the job, right? So, agency cost, you will have to understand that just appointing directors is not enough. There are other aspects also involved with their appointment, which you have to be aware of. Now, see, you can't be in a position, where you appoint the directors this year and then you give them a free hand and then you only just check whatever they have done in the next year. No, because if you do that, the directors will get a free hand and they will do what they please. And because they know nobody is watching over them, they might take undue advantage of this situation. There is a possibility that they will act in their own interest and not in the interest of the principal who has appointed them, that is the shareholders, which is why certain monitoring activities are very important. For example, the company will have to appoint independent non-executive directors who are a part of the board of directors. They are not employees of the company, but these are external people whose only job is to keep an eye on whether the executive directors are doing their job properly and highlighting any issues therein. Now, these independent directors are not going to work for free. They are basically your eyes and ears, and on your behalf, that is you means shareholder, on your behalf they are looking at whether the executive directors are doing their job, whether they are working on time, whether they are acting in the best interest of the company, whether they are giving contracts away to their related parties, or are they following the proper due diligence process and tendering process. You need someone to keep an eye on them, right? This could be in the form of non-executive directors. This could be in the form of your internal auditors, your compliance teams, and not one of them is going to work for free. So naturally, you will have to pay them something. You will have to pay them their fees, and that is a part of your agency cost. Okay. Then the second concept is residual loss. Now, the word residual means what remains. Okay. The word residual means what remains. The reduction in shareholder value resulting from excessive agency costs, such as directors awarding themselves excessive benefits beyond reasonable compensation. See, it is the reduction in shareholder value that still remains, or the residual loss is the reduction in shareholder value after monitoring and other costs have been removed. So, see, even if we spend money on audits, we spend money on paying to the non-executive directors, and we set up certain monitoring and compliance mechanisms, there is still a possibility that the owners and the agents who run the company on their behalf, they are not aligned with each other, right? So when you end up paying excessive agency cost, like you are paying an excessive amount to non-executive directors, or the executive directors that you have appointed to run the company on your behalf, they award themselves with heavy compensation packages which are completely disproportionate to the work they are doing and the time they are spending. So what is the cost that you are bearing? Because you can't be present for running the company on a daily basis, you have to appoint someone else to be your eyes, ears, hands, brain, everything in the company. So that reduction in shareholder value which happens is your residual loss. Accountability is the requirement that agents be answerable to principal for outcomes of their work and responsible use of resources. So ultimately, the directors have to be answerable to someone, right? And who should they be answerable to? The people who appointed them, that is the shareholders. The agents, that is the directors, are answerable to the shareholders because they are using the resources belonging to the shareholders, and they owe a response, they owe an answer in terms of how were the resources used, for what purposes were they used, were you true to the vision of the company, did you honor the values with which we are planning to run the company. So they will be answerable for all of that, which basically this answer is given in the form of your financial reports, in the form of your, you know, director's responsibility statement, annual report. So all of these are basically answers that you owe to the stakeholders in general. And then the last one is fiduciary duty, the legal and ethical obligation imposed on directors due to their position of trust and confidence in relation to shareholders. See, you have to understand that the directors are entrusted with money that belongs to the shareholders. And which is why there is a lot of responsibility, because these shareholders who have contributed anything from 10,000 to 10 crores to the company are looking at the directors. They have placed their trust in the directors to run the company on their behalf. And which is why that becomes a fiduciary position, a position of trust, which they should honor regardless of the circumstances that they find themselves in. And with that in mind, what exactly is the agency problem? The core challenge in corporate governance: how do shareholders effectively control the directors to ensure that the directors act in the best interest of the shareholders rather than pursuing their own objectives? That is the agency problem. How do you keep an effective control over these directors? How do you ensure that they don't plunder the company, they don't siphon the money out of the company for their own benefit, but they act in the best interest of the shareholders at large, and they honor the primary objective for the existence of the company, which is maximization of shareholder wealth? How exactly do you ensure that? What are the challenges that come your way is a part of the agency problem discussion. Now, uh, certain places, certain common areas where the principal agent relationship will be in conflict. we have a couple of classic examples. The first one of which is excessive compensation. High salaries, benefits, and easily obtainable bonuses, regardless of actual performance or company results. See, for the employees who work, say, a data entry operator or a quality control specialist, their salaries are decided by management. But who decides the salary of the management slash directors? It's not the, see, they are not answerable to anyone technically, right? They don't report to anyone. They don't have a boss over their heads who is going to check their performance on a regular basis. So that basically gives them like an open field to decide how much compensation they can get. What directors can do in such situations is they can end up paying excessive salaries to themselves, very much at the cost of the overall growth of the company. They might end up siphoning the funds out of the company, taking the money out of the company, when in fact that money should have remained invested in the business for, future projects, for future expansion. So in this case, the directors, by paying themselves excessive compensation, have acted against the interest of the company at large. Uh, Sometimes, you could have, what companies often do is, the directors, while appointing themselves or while appointing other fellow directors in the contract of employment, they could include certain clauses like the fact that the directors cannot be fired for a minimum period of 3 years from the date of joining, or they could include a golden parachute clause in their contract. Now, what is this golden parachute clause? The golden parachute clause is the very foundation of securing your own interest at the, making sure that your well-being is not harmed. For example, a golden parachute, what is a parachute? A parachute is an instrument that you use when you want to jump out of a plane which is basically going to crash. That is a parachute. So it is, and what is your mentality? Let anything happen to the plane, I don't care. I want to save my life, so I am jumping out of it by using a parachute. If the company's performance is declining, if the company is going through a tough time, the company is on the verge of closure, or it could be a situation that a director is underperforming and you want to fire him, but his clause contains a, sorry, his employment contract contains a golden parachute clause that if you remove this director from the company, you will have to pay him a hefty exit package at the time of his resignation. So that will make sure that the director's interest is taken care of, but the company's interest is at stake. Or there could be cases where the directors are using company assets for their own personal benefits, or they are giving these assets to related parties and not charging the arm's length price for this usage. And there could be situations, where there are external parties who are trying to take over the organization, and the directors, they are not thinking about the greater interest of shareholders. They are only thinking about what is most beneficial for them. In certain cases, it could be possible that a takeover could be in the best interest of the shareholders, right? But the directors want to hold on to their power, so they don't necessarily agree to the takeover offer from a competitor. So they are acting in their own interest, not in the interest of the shareholders at large. And that is another example of the principal agent conflict. The poison pill part that I have mentioned here, we'll study takeover defenses later, and at that time, we'll understand what poison pills are. Now, over a period of time, how do shareholders engage with the company? That has also changed. Individual shareholders, I'm sure, must have realized at some point of time in the past that they can neither influence the directors with their 50 shares that they own out of a total of 100 million shares. So they were okay with, so they ultimately had to make a trade-off. They realized that what they say is not going to make a dent on what the directors are going to do. So they decided to go a different way. What they decided to do was, okay, let's not get into that. Let's just focus on getting our dividend and capital appreciation and go home. If they were unhappy with the way the company was going, if it did not agree with their principle, uh, the easiest they could do was sell off the shares, make your money, and get out of the company. Over a period of time, these individual retail investors, they continued in the corporate system, but you also had a new creature, which was the institutional investor, companies which invest in other companies. It could be like a private equity fund, a bank, or any organization which invests in another company. These are institutional investors, not retail individual investors. And see, these institutional investors are there for making capital gains. Okay, these institutional investors are there for capital appreciation. They don't, and they are focused on short-term gains. They are not really interested in, participating in the day-to-day decision making of the company. So their presence was not really driving the company on the growth path. And over a period of time, this started changing, specifically after, a lot of corporate frauds that shook the entire world. I mean, right from Enron and APCA, which is this one, Thomas Cook, and all of these corporate scandals and frauds, somewhere the whole approach of shareholders, their involvement in the running of the company changed. And we are looking today at a very modern and evolved version of shareholder participation. Now, we did discuss briefly about agency cost. We discussed monitoring expenses already. Let's now discuss bonding cost and residual cost. Expenses incurred to demonstrate good faith, including financial reporting, shareholder meetings, voluntary disclosures, and incentive schemes. Now, we discussed that, see, shareholders appoint the directors. Therefore, directors are answerable to the shareholders. And what are the questions that the shareholders are asking? What is the sale that the company made? How much profit did we earn? Where all was the money spent? What is the position of assets and liabilities on a particular date? Tell us about the cash flow position of the company. The answers to all these questions are basically given in the form of a financial report, that is the financial statements. Now the management is responsible for preparation of financial statements, right? So these are your bonding costs, expenses that you incur to demonstrate good faith, to demonstrate the fact that you are in fact performing your duties properly, which includes the whole process of financial reporting. That is a very expensive activity. Appointing a strong finance and accounts team which will take care of the accounting part, then appointing, chartered accountants and ACCAs to prepare the financial statements. Then all of these are what? These are bonding costs. Costs that you incur to demonstrate good faith, conducting regular shareholder meetings, sending e-ballots, postal ballots, all of that is a part of the bonding cost. Voluntary disclosures that you are making about ESG and, sustainability and all of that. Then the last one is residual cost. Cost of agents providing themselves with additional benefits beyond basic remuneration, including excessive bonus and incentive schemes. The idea of residual cost stems from the fact that even after paying themselves regular salaries, the directors of the company, because the directors of the company might pay themselves additional compensation in the form of something like a compensation in kind, a company like of an apartment, the EMI of which is paid by the company, but the director and his family live in that apartment, or car that is used by the director's wife but is paid for by the company. So, and you will never know the details of all of these if adequate disclosures are not made. There is always a possibility that the directors of the company utilize this lack of knowledge on your part to give themselves excessive benefits and returns, and that is basically your residual cost. But it's not as if, agency theory is, or the agency problem that we discussed does not have a solution. The first step towards tackling this is alignment of the interests of shareholders and directors. Basically, doing the balancing act, making sure that the interests of the shareholders are also met and the directors, the agents, so to say, are compensated adequately for the effort that they are taking, and making sure that you are giving them adequate motivation, and also making sure that they are aware of any penal consequences that they will have to face in case they do not fulfill their responsibilities. Ways to do that could include devising an appropriate compensation strategy, making sure that the directors are compensated adequately for the work they are doing. This should be based on market standards so that they also feel valued in the organization. Giving them rewards which are driven solely by performance. So you could keep a portion of their salary fixed, and the other half could be based on certain performance indicators. Like somebody in sales, a sales director could have the overall sales achieved as a target, and if him and his team exceed that particular target, then he gets additional incentives. So that could be a performance based pay which will ensure that he works towards the achievement of overall company objectives. You could also give them stock options, employee stock options, which will give them a feeling of ownership about the company, and they will be then personally invested in the overall growth of the organization. And how do shareholders exercise effective control? By conducting annual general meetings. This is an annual meeting of the shareholders where they get together, and where they discuss the performance, the position of the company on that date, its overall competitive advantage, regular compliance activities. Basically, it's like that PTM that happens in school at the end of the year, where the parents come to see your performance and your report card. It's basically that time for the company where the directors give the report card of the company to the shareholders. The shareholders could also play an important role in board composition. They could request committee formation, like, having audit committees and remuneration committees and nomination committees. And all of these are ultimately, when we study corporate governance, we'll understand how each of these ultimately contribute towards the achievement of organizational objectives and keeping a tab on the working of the board of directors. Majority of the decisions in the company have to be taken with the approval of the shareholders, and shareholder approval is given by way of shareholder resolutions. See, most decisions cannot be taken unless there is agreement on the part of shareholders, and by voting in these meetings, the regular general meetings also, the shareholders could exercise that control over the directors. And ultimately, the last point they have mentioned is share divestment. The ultimate sanction involves selling shareholdings, particularly effective when institutional investors divest, potentially creating domino effects and making company takeover targets. See, if the institutional investors start selling off the shares, there will be a greater supply of shares in the market. The price might fall, and other people, outsiders, might see this as an opportunity to take over the company. Now, engagement of shareholders. See, it happens of regular shareholders, retail investors like you and me, it happens during the annual general meeting. But if when you want to engage with institutional investors, see, think about it. A company like Dharma Productions, okay, which is a company owned by Karan Johar. It was his family company. Now, Adar Poonawala, his company has taken a 50% shareholding in Dharma Productions. Now, this is not an individual or a set of individuals, but this is one institution, one company acquiring shares of another company. So, Adar Poonawala's company, Serum Institute, or whichever company that is a 50% shareholder, and that becomes an institutional investor. Now, the method of engagement with institutional investors will be mostly through one-on-one meetings where, specific issues and challenges and other activities can be discussed. But these meetings carry significant risks, particularly the potential disclosure of price sensitive information that could constitute insider trading if acted upon before public releases. A majority shareholder getting insights into the company, and this information getting leaked out, or this person thereby, because he has access to certain insider information, he takes a decision which disturbs the overall market order. This could have a possible impact of you know impacting the share price or causing market panic before the action or the activity already before it takes place. So you have to be very careful in terms of your engagement with the institutional investors. And Ultimately, what matters is balancing the interest of the shareholders and directors, active monitoring of their functions on a regular basis, of their active monitoring to check whether they are discharging their responsibilities in a manner that is so expected. And the last thing is stakeholder alignment. Modern corporate governance which focuses on keeping all the stakeholders satisfied and bringing their interests and bringing their activities on the same page. That is your stakeholder alignment. And understanding this agency theory is going to pave the way for a lot of other discussions that we are going to do in the future. Thank you.